Good morning, good afternoon, good evening, wherever you are. This is Markets for Millennials, and this is our weekly analysis from the week of August 15th to August 19th. And this week in the markets, not a whole lot of news events, just a few things that I wanted to mention before we get into the charts. And this will be pretty chart heavy for today without a whole lot of other discussion. I just want to point out here that we have the initial jobless claims on Thursday that are released, and these had actually been increasing for a number of weeks. And then, obviously, if you recall, at the beginning of this month, we had the explosive non farm payroll report, and that was showing that the labor market continued to be very tight. And what I was looking for is, as the weekly claims came by and continuing claims came by, are they going to be coming in lower, and are they going to reflect the ongoing tight job market, or are they going to start increasing, and then will they be a sign of maybe a worse payrolls report, maybe a worse than expected payrolls report next month? And the actual initial claims came in lower than expected and lower than last time. And so that's actually a really big beat. So in the case of claims, we're talking about unemployment. And so this means that you want the number to come in lower, if you want to show that the labor market is doing well and is tightening. The continuing claims was higher than last month, but it was lower than expected. So that's kind of interesting. So that's kind of a mixed bag. It's always the market seems to like better how it is versus expectation rather than versus last time. At least that's what I've noticed in data. And then the only other thing that was a kind of a big deal this week was the Fed meeting minutes that got released, and I tweeted through a few things that I saw when I looked through them on Wednesday. You can see right here, I say that the Fed's concerned that they have a credibility problem if they don't sufficiently see through the reduction of inflation, and that I don't think the markets are adequately pricing in their resolve. And they actually have said this previously. You can see here a significant risk is that entrenched or elevated inflation could become entrenched if the public began to question the committee's resolve to adjust the stance of policy sufficiently. And the whole point of that post was to just say that the Fed is afraid that if they were to, say, pause rate hikes right now, or cut rates or stop QT, then it would be seen as it would basically destroy their credibility, because they've been saying they want to reduce inflation, and they don't want entrenched inflation to become entrenched, and they're afraid that people will not trust them to bring inflation down, and that will start a spiral, because a lot of times it's not really whatever inflation really is. It's about what the expectations for the future are, and then typically people's behavior follows what they believe to be the case, rather than the other way around. So in any case, then we had some other things that I was really interested in seeing what the Fed said about their discussion about removing forward guidance. And what you actually see here in this little paragraph is that it says right here, policy or participants pointed to some evidence suggesting that policy actions and communications about the future path of federal funds rate were starting to affect the economy, most visibly in interest-sensitive sectors. And so what I really noticed about that statement was that they were basically telling us ahead of time what they were doing, but the market was reacting, and maybe perhaps in their view overreacting quite faster than they wanted it to, and it was having effects in the economy that they were not trying to do. So everybody's been making the joke about Powell talking about wanting a soft-ish landing, and I think this is kind of that whole idea, because a soft-ish landing would obviously be the most ideal result, And yet the market, as the Fed was guiding us forward all across this year, the market was actually not pricing in a soft landing. The market was pricing in something much worse. So, and then I thought this was an interesting comment, talking about how stress tests for banks, talking about absorbing losses from severe recession without breaching regulatory minimums. And this was in the context of talking about leverage, the amount of leverage in the system. And it sounds like to me what they're saying is that they are pretty pleased because they believe banks could survive a leverage unwind, which I thought that kind of brought alarm bells in my mind, but that's just kind of something I wanted to point out. I mentioned that the Fed has only been paying attention to year-over-year numbers, and there hasn't been any mention of month-over-month or annualized. And then I had really been watching for a conversation about what is the neutral rate, and so the Powell came out and said that they believed in this last FOMC meeting back in July, on the July 27th, that they believed that they were at neutral, and they just kind of left it at that. And what the minutes show is that they're looking at a longer run neutral level, and so maybe that's 3, 4, 5 years from now, or maybe 10 years from now, but that's not right now. And so you see here, even so, with inflation elevated and expected to remain so over the near term, participants emphasize that the real federal funds rate would likely still be below shorter run neutral levels after this meeting's policy rate hike. So essentially, Powell said they're at neutral, but then they actually are not at neutral. They don't think that they're actually at neutral for right now, and so I think that that's obviously evidence that we're not seeing a pause in September, yeah, I just think that that's kind of important. So with that, let's take a look at the charts. So today, so for this video, what has been really ringing into my mind are a couple of words: breakout, breakdown, rejection, and rejection. And the reason why I see it that way is because I'm gonna what I'm gonna show you today is where various markets were rejected, where various markets saw breakouts, and where various markets saw breakdowns. And so I'll start with the equity indices. And right now I have the red line here. This red curving line is the 200-day moving average. And you can see that price came up and tested the 200-day moving average exactly one time, made a touch with it, and then has been rejected off of it. Now, this is a slight rejection. It's not a huge rejection, and so like this is I posted about this on Twitter. This kind of rejection should be expected because you've had price underneath the 200-day for so long, and you've had this movement, this price action to the upside, such gains over the last 2 months, that you would expect price to be rejected here, as well as the fact that when you look back at the resistance that we have established, trendline resistance from our all-time highs, and then also from late March, we have a confluence right there of resistance that is coming in. And there are even, you could even argue that there's horizontal levels around that same area as well. And so it's not surprising that there's a rejection. But the part that I'm looking at is, are we going to hold our support right here? It seems pretty apparent to me that this is going to come off and we're going to get a test right here. And if that test doesn't hold, then I think we go down, and I think we touch this trend line, which is not very strong resistance, but still, or I'm sorry, not really strong support, but it is support nonetheless. So that's what I'll be watching for. But anyway, this is one of the rejections of the markets in the last week or so, over the last week, because it was rejected off of a pretty critical technical level. So, and then what's interesting is if you start trying to draw some trend lines on this asset, the only like any of the trend lines that you could potentially draw, other than the one on the bottom that I have right here, will show you breakdown. So if you do it this way, it's a breakdown. If you do it this way, it's a breakdown. My rule for technical analysis and drawing lines is I can't draw this line and connect it like that until unless price comes up and makes a higher high. And then if it does make a higher high, then that's when I will go to whatever the lowest red wick is, and I will draw the line that way, and that'll show us our trend. Um, but for now, I can't draw that, so I have to kind of. That's why I'm prioritizing this horizontal level as the most important spot. On the Nasdaq, you can see if I turn on some of my other moving averages, we got up between, we broke through the 100-day, and then did not get to the 200-day yet. So those lines don't matter in this case, but what does matter is this trend line that was broken, this trend line resistance, which is the same kind of trend line that I have on my S&P 500 chart. The Nasdaq did break that, and so we're actually coming in for the retest on that. So this technically is the most important spot to watch. Now, what I would say here is, if you're feeling bullish, if you think that the Fed pivot is here, if you have a macro picture that says that this is going to continue to run because the market is going to price in the coming pivot, and or perhaps even just that the fact that the economy is actually going to be far better than we think, if that's what you think is going to happen, then this actually, off this support trend line, is the perfect spot to take a trade, because what you want to watch for is kind of this August 9th and 10th level, right? So this was the CPI release. That's where the CPI release took place, and that's a really good line to watch. So let me just try to make that a little bit cleaner. You want to watch that spot because and use that as your risk to reward spot. So this is actually a very tight trade, but in this trade you'll know if you're wrong, because if price does come down below that level, then that means that we're probably headed downward, and it would mean that we broke the trend line to the downside. And so this is actually a great spot from a risk to reward standpoint, to place a long trade if you're just trading futures, or if you're looking for a place to maybe buy the Qs. So you buy as price settles here, and then you put your stop loss below this level. And maybe you even go a little bit lower, because we've got these red candles back in August 1st and 2nd. So maybe you set your stop loss right about there, and your risk to reward is great, because if it breaks down below this, then you're wrong. So I just thought I would mention that. The Dow, kind of an interesting look here, because the Dow got above that same kind of confluence that I pointed out on the S&P of the 200-day moving average and trendline resistance. The Dow actually broke above it, but on Friday's price action came below it, and so I'm watching. I'm still watching that spot, because this could have been a breakout and then a failed, kind of a fake breakdown, or this could be just a prairie dog breakout that's going to come back down and break down below. So this is more of what I would call a breakdown, technically speaking. Although we got to see follow through for this to really be a breakdown, and so once again, just like the S&P, I'm looking for this horizontal line right in this area to hold as support. And if it does not hold as support, then then I am assuming we're going to at least touch back down to 31,000 in that area, and then possibly go revisit our lows from June. And then the Russell, kind of a similar story to the Dow. We broke down. We had closed a couple of days above our 200-day moving average, and then broke down, retested it, and and then ended up resuming lower. And so this, if you look at this right here, this looks like a prairie dog breakdown, because you actually did get that pop above that technical level, but then we got rejected at this. I had this horizontal level a long time ago. It like going back to December 2020, January 2021, and it's interesting because price exactly closed right at it on August 15th, and then failed to close above it again on the 16th, and then after opening above it, closed below. So that's one thing to notice. But just if we're using the 200-day moving average as kind of our proxy here, then it definitely was a prairie dog, and then it broke down, and then retested out of that. And I think this candle, this green candle that tried to retest the 200-day moving average, is kind of the key here, because price tried to, if I go back to my Dow chart, price is already kind of a little bit ahead of this, where it tried to come back up to get back up above to prove that this breakout was the real deal, and it failed, and actually resumed lower. So I think that is a potential sign of things to come, for the Russell. Okay, so let's talk about breakouts. So the NASDAQ was a breakout, but obviously that started to break out last week. On the DXY, on Monday, straight away on Monday, we got a huge, 0.77% candle, that broke us out of this descending trend line. You'll also notice that we had popped down below. I talked about this last week. We came down and kind of touched this area of support. I was watching this yellow box, this kind of zone of support. The 50-day moving average was right here. And just in this whole trend, we've barely spent any time, just on a couple of occasions, closing below the 50-day moving average. But obviously, we've really taken off here. Maybe actually getting a little too overbought. So what I'm actually watching for here is for price to go sideways right below kind of the close of this daily candle from July 14th, and then breaking out above that. I am looking for the dollar to make new highs, and because like I said, nothing in the macro suggests that we're going to be in a situation where there won't be dollar strength because of what's going on with the euro and the yen. And then actually over the last week, the British pound really got super weak versus the dollar as well. And I just want to point out too, like, we never made a lower low. So even on this pullback, began, price action began coming off July 15th. It's been over a month of trading. And even though we got close, price never made the lower low, and we're actually just about to make a new higher high. And so that's really interesting. So super bullish on the dollar. Another breakout on the treasury yields and the 10-year. And I just keep, maybe I'm being, a little too much about this, but I've been asking myself, why aren't yields at, 2.5%? You would think that, given the CPI coming off, so August 10th, we had the 10-year starting to come off, and then it actually retraced and closed essentially unchanged on the day. And it's like, well, if CPI is peaked, then I feel like you would expect bonds to come off. I've actually heard a lot about this with inflation, people expecting inflation to be coming off, people expecting, maybe recession, or people expecting growth to slow down, and that's where we're starting to get into people saying that you should be buying bonds right now. And Raoul Pal from Real Vision was talking about that a lot, buying bonds. But to me, the interesting thing was even going back to the non-farm payrolls report, if you recall, from a while back, or I'm sorry, not the non-farm payrolls report, but going back into the early part of August, we had this candle that was down deep red and then actually retraced and moved up. That looked like an exhaustion bullish candle. So what I mean by that is it looked like the selling pressure was subsiding, that there wasn't, and like that the sellers were exhausted. And I looked at this as this was going to be the start of the reversal back up. And so, and that's what it looks like so far. We've broken out. Um, my Sam's indicator has changed from bearish to neutral, and so that's kind of a really big deal. I think, from a technical standpoint, if you want to watch maybe this to just see if the current trend holds, maybe it should be more like that. Let's see here. Got to get the magnet on so that it actually locks on. So if you want to look at that, if we break down below, then could we go lower? Sure. I don't really think that that's important. I think the bigger thing was that all the people um, who were watching what were these head and shoulders patterns, that those head and shoulders patterns have been nullified now, because every way that you could possibly draw this, the neckline, it's been broken out from. So that's been nullified. And so, everyone was saying, there's nothing between here and, where was this, like under 2%. But obviously we're headed back upwards. And I've been saying for a long time, I expect us to get to at least one more new high, new 52-week high before we actually hit the peak of the yields. And I still stand by that. Let's take a look at gold. Gold, we're saying break down here. So a couple of things. I adjusted this trend line, and I actually noticed that this is a channel that we've been in. And so I expected a break. I expected this to get rejected here. So that is a rejection, and we have a breakdown below our 50-day moving average. So obviously the momentum is down. Not only were we rejected at the trend line resistance, we were rejected at horizontal resistance. So again, these confluences are proving to be excellent places for you to, in this case, to sell with really solid risk to reward. Again, your risk to reward would have been just above that wick. So if you were looking at price when it broke below the 50-day moving average, you set a trade to the short side, and your risk to reward is perfect, and your risk management is perfect as well. And so that's I think that's a big deal. Definitely gold is still disappointing, and I actually think we are. The more I see of it now, I actually think we're going to break our 2021 lows, which were right about there. So that's the next place I'm looking at to see gold test. And it's pretty crazy to think that just after a few days, we're already, like we've already retraced 50% of these gains that we've had over the last month. So something to watch. Crude oil. I drew in these trend lines because I was trying to look for places of possible support. I'm not really sure if I like these lines, but I'm still flexible with it. But I do want you to notice price playing with those levels, sort of, kind of. Maybe if I adjust this line up, you can kind of see that works there. If I adjust this line, you can see that line works. This line works. Maybe this line, maybe we'll do, yeah, this will work. So we have continued to make lower lows and lower highs, but I'm watching this trend line to see if we get a breakout and get sustained price action to the upside. The rate at which this is dropping is starting to slow. And so to me, the line in the sand for oil that I'm watching is right there, that lowest trend line. So I want to see if we can kind of bottom along here and then start to come up, because I am long-term bullish oil. So that's what I'm watching there. And then let's take a look at the Bitcoin chart. So actually, let me use the CME chart. I started looking at the CME chart because I thought institutional investors that are exposed to Bitcoin through the futures are using the CME. So I thought this would be a good way to look at it. So we have a breakdown of this ascending wedge. And obviously when an ascending wedge breaks down, that's a bearish pattern, obviously. It's already intrinsically a bearish pattern. And so you can see that tried to hold and then failed. Friday was a huge down day, almost 10% on the CME. It's a little over 9 technically. That was a breakdown. Let me go to my normal chart because I want to show you the breakdown from this chart. And obviously here today on Saturday, we are up a couple $100 on Bitcoin, but it pales in comparison to our drop. We are at the low yesterday. We were down at 20,793. Not honestly too far away from our closing lows back in mid-June, which were closing down at 18,951. The Bitcoin chart is ugly. And obviously, you pull back and you look at this chart and you're like, yeah, that's ugly. We aren't even close to getting back up to our long-term descending trend line resistance. But what we've been seeing over time are these counter trends. So in this larger downtrend, we've had one counter trend, we've had two counter trends, and this is our third counter trend. Um, and that's kind of the way I viewed this. And my bias is because everything has been so correlated. I thought I kind of have the view that stocks are going to go down and other risk assets and high beta are going to go down. And so it's hard to kind of see Bitcoin as being able to be immune from something like that, any kind of washouts or anything like that. So I've been kind of looking for this to tip over. But then also let's take a look at a couple things. In the blue is the 50-day moving average. So we had started getting above that. But on yesterday's close, we broke down below it, closed below it. We were rejected by the 100-day moving average 4 times, 1, 2, 3, 4 times. And so I thought that was a pretty important thing to notice. And then the one that a lot of people have been watching is I don't know why this is doing that. Sorry about that. This purple line is the 200-week moving average. So if I were to go to my weekly chart, log scale this thing, and pull it back, people watch the 200-week moving average because of in Bitcoin's history, these tended to show you kind of where bottoms were. At least that's been a popular metric for looking at that. And so we definitely closed below that. Let me go back to my weekly chart and zoom it in a little bit. So we're definitely closed below that after holding above it. I think that is not a good sign. I think that's the sign that kind of what I've been looking for, not wanting, by the way, but looking for is going to happen. And so let me go open up my MRT tool. And the reason why is because I occasionally have posted updates about this. Let me turn off the other drawings. There we go. So Bitcoin historically has at some point crossed or touched this orange line below, and it did not quite get there on June 18th. It was close, but didn't quite get there. So when we started to come off right about here in late June and early July, as we got down there, I thought we were going to get a touchdown there, and that was where I was going to be a buyer in huge quantities. Because that's been the historical bottom. So let me show you. Let me go on the weekly chart, and let me go back really quick. So, we get the touch here down here on this candle from even after the post 2011 peak. So once it touched there, that was the bottom. And then when you go to the bear market after the first halving, so this is in January 2015. You actually came below it, and then that was the bottom. Obviously, we got to similar price levels in August of that year, but it was quickly recovered, so this marked the bottom there. And then in the 2017 bear market, 2018 bear market, we touched and even closed for a moment below that level. So that's a level I've been watching. And we didn't touch it yet. And so when we crossed above the yellow line, then that's when it starts getting interesting. And ultimately, what I was watching and what I tweeted about recently was a close above the green line. If we can close above the green line, that typically means that price will not go down and revisit the yellow line. So let me go back through Bitcoin's history. So this is obviously the March crisis in 2020, the liquidity COVID crisis. So that obviously is in black swan events like that. Like obviously, this rule doesn't apply. But in this case, once you closed above the green line, we never went back down below except for that situation. If I go back to earlier, so the rule is you have to touch orange or at least close below yellow. And then once you close above green, so like it actually closes above green here and here, we never go back down and touch yellow until the next bear market. And so that's why I was watching. You can see here too, get above green, close above green. We never go back down to yellow. So that's why I was watching price as it was approaching getting closer to that green level, because if we had closed above the green level, then if you hadn't bought in by then, like, I mean, that's still a good opportunity to buy in terms of the overall gains that you would have, but it's not as optimal as trying to, obviously, when you're buying from the bottom. But anyway, now we're far closer to going back down below yellow than we are to getting and closing above green. So I'm still watching that. I still think that that's important. And so just something I wanted to bring to everyone's attention. Definitely being below the 200-week moving average is not a good thing for Bitcoin in the long term. So anyway, that is a look at the markets, and again, just lots of different things going on. It'll be really interesting to see over the coming weeks where price goes. And that's all for today. And so I hope you enjoyed this. Please make sure you hit the like button and subscribe if you have not. And I will see you guys next time.